you for meeting with us. We're greatly appreciative of your time. Dave Witte with IHS, and this is Robin Dupree with BIC Magazine. So what sort of construction trends are you seeing or foreseeing? And then I'll tie in the second question as far as, do you feel that construction is tailing off? And can we look forward to a second wave facilitated by chemical company investments?
Yeah, so I guess from an IHS Markit perspective, the energy value chain continues to build out all the way starting at the wellhead and going down through the midstream pipelines, the export terminals and facilities, as well as the domestic logistics, and then down into the chemical and in some cases refining side. So, that is all really continued by shale and shale developments. From an overall perspective, we're quite bullish on the opportunities that shale has. This year, the Permian Basin will probably surpass all kinds of expectations of just a few years ago. We expect Texas is going to be producing something like 4 million barrels per day of crude oil. On its own, that would put it at number 7 in the world if it was a country.
Yeah.
And the U.S. Is going to move into the number 1 position sometime in the next 6 to 12 months in terms of overall production. So that's creating opportunities on both the natural gas chain as well as the natural gas liquids value chain, and then in terms of exports for crude oil, other opportunities. And so the construction side itself, we're quite optimistic about on an overall basis in terms of opportunity. I think the challenges have been in terms of the efficiency and the effectiveness of what's been getting built. The capital construction costs are quite high. There's been quite a number of delays. Some of that's weather related. Some of that's in terms of trying to bring back and build up a labor force, a direct hire labor force that hasn't been in place really for more than a decade. And so while the opportunities are there with shale, we're a bit concerned about how much of that the U.S. gets to capitalize on, and as opposed to markets overseas. So, for example, within the ethylene polyethylene value chain, which is one of the keys, we have seen a big wave of investment by those that already had established facilities in the first round that could build on brownfield expansions. And those are underway and now being realized in the final throes of commercialization or through the next 6 to 9 months, finalized construction. And there's a number of others that have been planned and are also underway. Some have passed board internal approvals, others have to get final investment decision and approval by their boards. We think that this trend could continue on through 27, but when that in that value chain that I was going to go down into, there's a question as to what do you actually export and where does the plant get built. So, for example, you could build the pipelines from the Permian and the natural gas liquid processing facilities and the export facilities to export ethane and build that facility in China, or you could build it here and export polyethylene pellets or ethylene glycol, some of the finished product. And the decision on where you stop and where you continue to build is a function of the overall competitiveness of not only the cost, the delivered cost of those products into the markets that you're focused on, but also what the relative capital cost is. And China can really eat our lunch with respect to CapEx. And for example, by our estimate, someplace between 50 to 70% of the construction costs on the U.S. Gulf Coast. And so when you take that into consideration, it's quite possible, and we're seeing a number of projects being developed in China, that rather than have that ethane be converted and produced into pellet and then exporting the pellet, where we get all of that capital construction associated with the ethylene and polyethylene facility, we could simply be exporting natural gas liquids and having that capital construction being pushed onto on the overseas into the Chinese market. And so we right now are calling for the vast majority of the capacity to be built here in the U.S., but that assumes that we're going to see some pretty significant improvements in overall capital productivity over the next couple of plants that get built, because otherwise, there is the potential for overseas companies to come in and kind of take that feedstock away from the U.S. Gulf Coast and put those plants up in China rather than the United States.
So building versus transporting it, they must see that there's enough production that's going to come online to foresee building a plant and going through all of the regulations and everything needed to build a plant versus shipping it. So they think that this will be on the market for quite some time.
Yeah, so from a demand standpoint, whether or not you make the polyethylene here or you make it in China, our view is the chemical demand growth is going to be significantly concentrated into the developing world, into the highly populous regions of India and China and Southeast Asia, where, in total you're looking at something close to half the world's population. And their consumption of chemicals much, much lower than the developed world. And so the demand is primarily overseas. Okay. And it's going to be there, in our opinion, as these economies progress and their middle classes develop. They're going to move up the consumption curve, perhaps not quite to the level that the United States, Europe, and other places that are developed economies will, but it's going to be there. So the question then is, what is the most effective way to service that demand? Mm-hmm. Do I build the plant in the United States and export the pellet, which as a solid is pretty cheap? I can fill up a 40-foot container with bags or super sacks and essentially export it into those markets and satisfy the demand. Or I can refrigerate and compress the liquid feedstock, the ethane and the propane, and move that overseas and convert it into China to satisfy that. So the end market is the same in both cases. It's a matter of what's the most efficient supply chain to get you there. Okay. And so, the decision on where you build is a function of delivered cash costs. Since it's a lot cheaper to ship the pellet than it is the liquid, you end up with a lower cost of production by making it in the United States and shipping that solid pellet to China. Mm-hmm. But from a capital standpoint, and paying for the capital to convert that, it's a lot cheaper in China than it is in the United States. And so, the rate of return is actually as good or better in China, but you could end up with a production cost that puts you out of the market. So when markets go down, if you're the high-cost producer, you tend to suffer a lot more. And so there's some risk by trading capital for cash cost, in both those cases. But it's not a slam dunk on which way you go, quite frankly. And so that's kind of where the jury's out. We believe the feedstocks are there to convert it. Where they get converted to satisfy this demand is another question.
Yeah. And then you touch base on the labor shortage. So I read an article that specifically the Gulf Coast, we are buying for the same labor as the rebuilders of Hurricane Harvey, and that they are at a standstill, both markets, because they don't have anybody to build these facilities or renovate these homes. So what do you feel the industry is?
Yeah, I would say they're different markets to some degree. On the margin, some of the labor, especially the more unskilled labor, may be in competition with recovery from the hurricane. I think most of the issues on the low productivity in the U.S. Gulf Coast, at least from our perspective, has come from the more skilled labor, welders, pipe fitters, instrument techs. Those aren't the people that are going to be, sure, putting in tile at your house or sure, putting in drywall and sheetrock. When you get to the final, putting on insulation and what have you, you may see some of that. So it's more of a competition between facilities that are being built. So if you've got a lot of facilities in a specific labor market, say in Freeport or in Houston Ship Channel or over in the Baton Rouge, Plaquemine, Geismar area, they're competing for those same kind of skilled laborers. But I think secondly, the bigger issue as well is also in the supervisory labor of those crafts, and that is really where there's been a big problem, because Historically, if you look at what happened between 2000 and 2010, when the opposite of what shale had happened, and you had Chevron and Shell and ExxonMobil and all of these folks saying, we're no longer really going to spend much money onshore for development. We were shutting down chemical facilities. We had shut down facilities between 2000 and 2010, so we weren't really building anything. A lot of companies, EPC companies, left, and so we lost that direct hire labor force, and we weren't feeding it up from kind of the bottom, from the younger folks, because they didn't see an opportunity to really come into something that was growing. And so you had this slug of labor that was there, that was doing turnarounds and smaller capex expansions and what have you, that kind of aged, and nothing entering the workforce. And so when you come back now and you've got this huge push to try and build, all of a sudden you're missing a piece of the labor force that's trying to come in and fill it. And so you've got really tight skilled labor force, welders and pipe fitters and what have you, but you also are missing a lot of the field supervision that can take a bad situation, and because of poor planning or because of the inability to really focus on it, make it even worse. And so that, I think, is where the situation is. Not so much a competition with hurricanes, but really a fundamental of where the labor market was, a rapid transition to a huge build out, and kind of a gap in the labor force, in terms of what was aging.
Skill shortage.
Yep.
Okay. So do you expect for planned refinery outages in the U.S. to cause a shortfall in the supply of petroleum products?
The answer is no. And we're almost through the heat of the turnaround season at this point, and it's gone fairly well. We had some refinery issues up in Wisconsin with the Husky fire, and we've got some continued kind of nagging outages here in a couple of cases. But for the most part, the U.S. system is past the peak in terms of planned turnarounds. And so, we don't see that there's going to be continued issues. Matter of fact, by the time we get to the end of May, I think our forecasts are that we'll be back to close to record production rates of refined products. Now, I think there's a couple of things to watch out for. One, on the demand side, the export demand has been very, very strong. And so, if that continues, that's going to continue to create some kind of tightness around the U.S. Gulf Coast. And then obviously we're, just starting to heat up towards hurricane season, and those unplanned weather-related outages or other outages because of unplanned turnarounds can cause a problem. So the refining system in general is fairly snug. Not because of issues on turnarounds, but just because of where the global growth is on fuel refined products, and the U.S.'s system is running pretty hard. So anything that impacts from an unplanned standpoint could have some problems or cause some problems in the overall system and growth.
And what about the number of startups? I know there are a couple that are in the works as far as commissioning and pre-commissioning. So do you foresee a couple more that are coming up in the near term?
Yeah, so if we shift downstream from the refinery side into chemicals, that's really where most of those startups are happening. And we've got a few of them behind us, the CP Chem and ExxonMobil with the large cracker. As we get into later this year or middle of this year, we see additional startups in a number of different places. For example, in the Sasol system, in the Indorama cracker that's being rejuvenated, and there's a couple of others. And so we're going to continue to see demand for commissioning and pre-commissioning services as we go all the way through the first quarter of 2019 across the U.S. Gulf Coast, and this is construction that's been underway for the last 2 to 3 years, so it's pretty good visibility on where we are. Then there's a little bit of a gap in 19 to 20 as we wait for, I wouldn't call it the next wave, but as we have a little bit of a gap in terms of when the next startups are. And then we're continuing to watch. There's additional FID being taken and construction underway for a number of plants from Corpus Christi all the way over into Louisiana, whether they're methanol facilities or olefin polyolefin facilities, all the way through 2022. We see pretty good, strong construction and pre-commissioning growth as they continue to take advantage of the hydrocarbon resources from shale.
Great. Okay, what about regional trends? What are you witnessing within the sector, and specifically the Gulf versus Appalachia?
So, yeah, this is a really interesting one. Obviously, Shell and PTT are both up in what we would call that crescent, the Marcellus Utica plays, which are much lighter, more gas liquid oriented, and so we're seeing interest in additional builds up there. We think there's enough feedstock for another 5 world-scale facilities up there. The question, similar to the one I said earlier, is where does it get built? Because you can export ethane out of the East Coast, or you can put it into pipelines, move it down into the U.S. Gulf Coast, and have it, have the plants be built down here. It's probably going to be a mix of those. Shell's talking about another phase to its cracker up in that area. The opportunity to build within the cluster and the brownfield sites that are in the U.S. Gulf Coast offers some de-risking rather than building a brand new grassroots greenfield facility in that area. But there's some advantages up there as well. You've got a lower feedstock cost because generally the region is long and it has to push it by pipeline down into the U.S. Gulf Coast, so you're paying those pipeline tariff charges. You're also fairly close to where the demand side is because most of the manufacturers of converted products sit in that Midwest area in Illinois, Wisconsin, Ohio, up into Michigan, servicing a whole host of different industries. And so, from a demand standpoint, you've got lower delivery costs on the outbound side. And so, there's some real production cost advantages that can happen up there. Offsetting that is a little bit higher capital cost, a bit higher risk because you don't have the clusters that you've got available. You don't have the huge workforce, that's been developed over 50, 60, 70 years to kind of service, the U.S. Gulf Coast and the specialization of labor that sits there. And so it's a little higher risk to be up there, but it's also offset by, lower feedstock costs and distance to market.
Okay. And what are your thoughts about the biofuels reform?
Yeah, well, this is an interesting one. I mean, from a biofuel standpoint, obviously there's a couple of things that are going on there. We've got, on the one hand, the waivers that were granted to the small refiners,
which caused a little ripple.
Which caused a little ripple, and so there's always been this political and industry divide between agricultural and oil, right? And so I think the view is that the RFS, the reformulated fuel standards, probably are in need of a rewrite. When the Trump administration came in and started to grant waivers to the refineries that were under 75,000 barrels a day, it caused a more of a ripple, and from the standpoint of the corn farmers who said, hey, look, this is going to impact us from an ethanol demand. We're not so sure. At the end of the day, you still have to put the same amount of ethanol into the fuel side, but it did give them some argument to say, okay, well, we need our offset on that as well, and that being, rather than being prohibited from making 15% by volume content ethanol in the summer, we need a waiver on the RVP to be able to have that that offset. And I think given that we're in some kind of tariff-related discussions with China and some potential repercussions to the ag lobby. The ag lobby gets a little stronger, the agricultural sector gets a little stronger in its arguments. And so the waivers have already been given. from a biofuel standpoint for the refiners. The waivers have not been given yet for E15, and the politicians that are in those farm states are pushing the Trump administration pretty hard to allow the waivers. There's been some bills introduced in Congress to be able to formalize it into law. We think the EPA believes that they've got within their rights the ability to give a waiver on RVP over the summertime to allow E15 blends to come in. Whether or not they do that, or whether or not they push that back to Congress to, to open up the RFS from a legislative standpoint, I think is the tough call at this point. But something's probably going to give. We're getting into the period where the corn farmers want to see that. So from a biofuel standpoint, there's a little bit of a push-pull to see, if the RFS standards can be levered one more time to make room for both sides in terms of what's happened. From a broader global standpoint, our belief is that the productivity on corn and acreage in general has gotten very high, such that there's probably too much acreage being planted in corn, regardless of what happens, from an ethanol standpoint. China has announced that they're going to go to an ethanol standard, but we don't think China needs U.S. corn to be able to meet that. They can probably do it internally. They've got huge inventories and stockpiles of corn, and they've also got the ability to get more efficient on the acreage. So there's a broader agricultural question in terms of what gets planted, but within this question of fuels, still some things need to be worked out on the overall whether the waiver is given or not, and I think that'll probably be more clear in the next month or two.
Okay. So you think this conversation will be ongoing for quite some time?
This conversation, maybe not for some time, but it's going to be ongoing for a month or two. There's, on the one hand, the Trump administration could come in and say tomorrow the EPA grants a waiver such that E15 can be produced. We're not so sure the corn growers would get what they want out of that, because there's problems in terms of distribution. California wouldn't opt in. There's problems in terms of which cars can take E15, and so we're not really convinced that it's going to be the panacea that the corn lobby thinks it's going to be, or the agricultural lobby thinks it's going to be. But the Trump administration could make that happen tomorrow, or they could try to squeeze Congress to actually opening up RFS and fixing the problem more fundamentally, which is probably the better way to go from a longer-term solution.
Okay. All right. Dow and DuPont have recently merged. Do you foresee more bulk manufacturers merging?
Yeah, so I think to answer this question, you got to look at the reasons why these mega mergers have happened. Dow and DuPont didn't merge so much to combine their hydrocarbon petrochemical assets, although there's clearly some synergies there. This was driven by their agricultural business, their seed business and their fertilizer business, and what was happening, in some of the larger commodity food growers in the world that were putting a lot of pressure on, what is a fairly fast-growing segment of those businesses. And so we saw the entire ag chem sector reformulate and restructure. It isn't just ag in Dow and DuPont. It was Syngenta and Bayer and BASF and a whole host of others that were in that sector that forced consolidation because of where the business was. Now that that's happened, there's also some other opportunities and problems that solved. There'd been quite a bit of pressure on, especially on the Dow side, for them to break up their specialties and their commodity businesses from activist shareholders. And so this gave them an opportunity to come together as a company, form a very large and competitive ag chem business, but also split, and their plan is to split into three companies, right? An ag business, the legacy DuPont business, which includes some of the performance plastics side of DuPont, and then a specialties business. And those will be kind of spun back out sometime next year, probably. And so, the drivers of that merger, are different. It's not so much the Dow DuPont merger, and we've seen, because of that, as I mentioned, other ag companies in the whole industry structure. Similar thing has happened in the paints and coatings side. Similar thing has happened in the industrial gases side. And so, there's kind of these coming together when you get a big change of the leaders in the industry creating a different structure. Everybody's looking for a dance partner so that they can also be competitive in what is a more largely scaled business. And so, those are kind of one-time events. As a result, though, we're expecting that there's going to continue to be some pretty significant amount of M&A in the business, maybe not to the total dollar value as we've seen over the last couple of years, but the number of deals there. And some of it will be a result of, the government authorities requiring spin-offs of certain segments of business, or businesses that don't fit together, as they're put. And so, you could see the legacy DuPont, for example, spin off a few businesses, and some of the other ones that, that have done the same thing. And that'll create some opportunities in the sector. And then there's some broader M&A that's happening, just to be able to get scale, and, some of the same kind of drivers. China is looking to try and bring in more specialty-oriented chemicals. India is trying to bring in more specialty-oriented chemicals. That they don't have that, within their borders. That's going to mean that they're going to be looking to Europe and the United States to try and find those kinds of capabilities to be able to bring back to those countries. And then within the U.S., probably some opportunities, because of the change in the corporate tax structure, with reduction in corporate taxes that will help to provide some financial incentives for overseas companies to do a little bit more cross-border type of M&A that's happened.
Okay. And as far as refinery closings, that I know that happened years past. It was the trend, but now it seems with everything that's going on with the current industry, do you feel that there will be any refineries closing soon, or will they just change what they're...
Well, I think in our view, the next couple of years, partly due to really strong demand growth. I think one of the unsung heroes of this last cycle has been, the growth. We've seen a super cycle of demand growth, 1.4, 1.5, 1.7, 1.8 million barrels a day of annual average demand growth in refined products, without any comparable amount of investment on the supply side. And so the market's tightened up, and we have pretty reasonably strong earnings by a historical standpoint for the refining sector, at least through 2020, 2021. And on top of that, we're going through one of the most dramatic changes in terms of fuel standards that we've seen since, the impact of, new oxygenates, for example, and that has to do with IMO. The International Maritime Organization has basically put in place some lower specification requirements on fuel oil, bunker fuels, for the industry beginning in 2020. And the industry isn't ready for it. The industry isn't investing, and rightly so, to be able to get the sulfur levels to where they need to be. And so, because by our analysis and others as well, the way to deal with the need to be able to have lower sulfur fuel is to put sulfur removal on the vessels themselves, scrubbers on the ships. And the shipping industry is in such bad shape that they're not really willing to fork out the money to do that. And so there's going to be, we don't think the industry is going to be ready to supply the fuel that's needed. And so as a result, refining profitability, especially heavy configured refineries that have cokers and can process heavy sour crudes, are going to make a lot of money as they try to deal with these dislocations from what the new specification change is versus what the capability is. And that's going to probably also amplify what is a relatively tight supply-demand situation for the next few years. So even in the 2020-2021 timeframe, we don't see refining margins coming under pressure. Post that period, we do think that there's going to need to be some additional refining capacity taken offline. And the smaller refineries, the less complex refineries in Europe, some here in Latin America, some in Asia Pacific are going to be under some pressure for rationalization as we see new capacity being built in places like the Middle East. This is all happening kind of under a broader, longer-term trend of vehicle electrification and what's happening, and you may have heard some of this, in terms of our views, what's happening with autonomous vehicles and software from Uber and Lyft and what have you, and that's pushing a lot of the national oil companies to forward integrate into their own refining system, forward integrate into petrochemicals, and so there will be new capacity built as these companies look to put on big new integrated refinery and petrochemical facilities that will pressure some of the smaller facilities, as we're seeing plateauing or even declining transportation fuel in some markets, specifically places like Europe, for example. They'll start to feel a lot more pressure. Now, it's not easy to rationalize those because the politics of shutting down a facility is very difficult, displacing workers and all of that kind of thing. So shutdown costs can be pretty high, but we do expect in the longer term we'll start to see rationalizations. But in the next 3 to 5 years, the industry fundamentals are such that we expect that there's going to be very little rationalization across the industry, and the industry should be in a pretty strong profit situation.
Okay. And last question, ethylene was heavily discussed at CERAWeek. So if you could give me some pointers about that, where is that heading, and what does the market foresee with that?
For ethylene?
Yeah.
Well, ethylene is the largest commodity building block petrochemical that there is. Mm-hmm. It's a market that's roughly 160 million metric tons globally. It grows at something like 1.2 to 1.3 times GDP. So, if you've got a 3% growth, you're looking at 3.5 to 4% growth in ethylene globally. That implies something around 6 million tons of new ethylene capacity that's needed to satisfy the demand growth. And 6 million tons is 5 new world-scale facilities a year. And that's a lot. And so, if we look at around the world where the opportunities are to build those facilities, they're here in the United States or in China if we export the feedstocks like I was discussing before. But in the scheme of things, even as prolific as shale is in the Marcellus and the Utica and the Permian, we see, maybe there's another 8, 10, 12 world-scale facilities available between now and 2030. So in the next 12 years, the world requires 72 world-scale facilities. The U.S. can provide 12 of those, maybe 12 of those. So that's a sixth of what the world needs. So the other 5-6 has to come from other places, and it's going to come, from investment in facilities that crack higher cost liquids like naphtha, and that is going to probably be located because there isn't this big cost advantage in terms of shipping feedstocks around. That's going to come in places like China, come in places like India, come in places like the Middle East, Russia, a little bit in Latin America, outside the United States. We're going to be primarily focused on those investments that are leveraging the natural gas liquids that are coming out of the shale formations here and in the Northeast. I'm looking forward to the opportunity. I think we're kind of at a crossroads for the conference as a whole, the industry as a whole here in the U.S. Gulf Coast. This decision over capital productivity is and where you build the capital here or outside the United States in low-cost places like China means that the industry really needs to address one of the most pressing problems in terms of capital productivity, and this conference is a great opportunity to kind of discuss what the fundamental root causes are and to be able to look at opportunities to improve the overall construction supply chain so that the capital efficiency and performance can get back to the point where those facilities are being built in the United States rather than those facilities being built elsewhere, because we know they last 30, 40, 50 years. They provide a tax base for additional revenue. They provide growth in terms of jobs, and they help the overall trade balance because we're adding value to what are those raw materials that sit in the U.S. So
great. Well, we look forward to hearing you speak.
I look forward to doing it.
Thank you so much.